Thank you very much for joining this webinar, this monthly Cash-Through Options. My name is Brad Renard. I'm the Chief Publisher of monthly Cash-Through Options, and I run the IC1 strategy. Thank you very much for joining us. Nothing in this presentation is an offer or solicitation to buy or sell any security. Okay, this is for informational purposes only. Just please read the rest of that. Thank you. Okay, we're going to do a brief overview of the risk-reward graph for an iron condor, but we're going to spend no more than 5 minutes on it. We'll talk just a little bit about directional, non-directional trades, discerning between the two, but we're going to primarily focus on what we see with the markets today. So part of that is technical analysis, macroeconomic analysis, sentiment analysis. So this is what we're going to spend most of our time on. And we'll do other presentations probably within 3 to 4 weeks. We'll have a webinar called Fundamentals of Iron Condors and Credit Spreads, and that's where we spend a lot more time digging into the creation of the actual iron condor and then how to adjust them. Okay, a little bit of my background. So our firm is out here in Silicon Valley. We're in San Jose, California, about an hour south of San Francisco. And I started off as a design engineer in New Jersey at the GE Aerospace Division. Went back to business school, came out to Silicon Valley, and I was in marketing, sales. I was VP of sales for a few companies. I was a co-founder for a company. One of the largest companies I worked at right out of business school was Cadence Design Systems. I was with that company for 8 years, and we focused on chip design software. So all the software that's sold to electrical engineers to develop microprocessors, memories, video chips, any type of semiconductor. Once I left Cadence, I went to a bunch of small companies, and then I co-founded a company. Then I went to Japan for a few years, but mostly out in Silicon Valley ever since 1990. My education, I have a physics degree, electrical engineering degree, and an MBA. So I traded stocks from the time I was in college, and then I moved into options in 1999. So the products that we have here at Monthly Cash-Through Options, we have the IC1, Iron Condors and Credit Spreads. I'm the chief publisher. It's been running for about 9 years now. It's an income-generating, non-directional strategy. We sell far out of the money calls and puts. And the calls and puts that I focus on are really 30 days or less, and they focus on 87 to 91% probability trades. The question came in and said, will this webinar be recorded? And the answer is yes, we are recording it, and then it will be up within a couple of days on the website. We primarily, for the two strategies we have, for the non-directional strategies, we focus on the SPX, the NDX, and the RUT. That's the S&P 500, NASDAQ 100, Russell 2000 small caps. NASDAQ 100, by the way, those are the big cap technology stocks. And then, of course, the S&P 500 are big cap multinationals, big cap stocks. The objective of the IC1 strategy is to hold the spreads until expiration through settlement, where they will expire worthless for the buyers, and they'll be 100% profitable for us, the sellers, where we keep the premium. This service, IC1, is offered as auto trade and self-managed. We also have time decay, auto trade service. Chief publisher is Amir Atabaki. Income generating, non-directional strategy. What he does differently is he sells far out of the money calls and puts that expire in 30 to 90 days. So he'll bring in more premium, and then he cycles out of them. He opens them, closes them, opens them, closes them. So he focuses on the same indexes. His objective is to close all spreads before expiration and book 40 to 70% of the premium collected as a profit. So really no trades will go through settlement or expiration. We also have the MCTO letter. I'm the chief publisher for that. I do get some help from the other folks in the firm, but I'm the primary publisher. It's basically the analysis that I've been doing weekly for the last decade and a lot of people have, thousands of people have used it over the years. But what I've done is I stripped out all the IC1 trades out of it. So there's no credit spreads or iron condor trades in it, and it's just the analysis, and then I add additional analysis to help all types of traders, regardless of the strategy that they're using. So it has technical sentiment, macroeconomic market analysis, can help investors and traders better time their entries and exits, regardless of their preferred strategies. That's delivered via email every Sunday or Monday. And we put a pretty inexpensive price on it, $35 a month for that newsletter. Okay, there's a 30-day free trial. We also are under development. We're working on a directional options long-short strategy on stocks. I've been working on that for about 6 months. I've hired a person I've been working with, and we'll be probably launching that in the next 6 months. And then calendar spreads, and reasonable probability we'll be finding someone with 3 years of experience already with certain level of training to do calendar spreads, because I know customers have been asking for a calendar spread service over the years, and I think that would be a pretty good fit for what we do. That's another non-directional strategy. Okay, directionals versus non-directionals. So directional trades, such as calls, puts, debit spreads, we're an options house. We don't really buy just the stock or buy the index. We'll do all the analysis, trying to figure out and predict where the underlying is moving. Is it going up? Is it going down? Or is it going to trade sideways and choppy? Once we understand that and have a prediction and a conviction, then we'll open up a particular strategy, an option strategy that makes sense on that trade. So we're an options house. So everything that we do is really options. So when we say directional trades, we're mostly opening calls, puts, or debit spreads, or maybe some directional butterflies. But we try to keep the options trades somewhat simple. The hardest part is really doing the underlying analysis and technical analysis and fundamental analysis of really where certain stocks are going. Directionals in general, they take they take a lot of time to research, open the trades, close the trades, manage the stops, replenish the trades. You have to be able to handle the anxiety when trades go the wrong way. And when something goes the wrong way, you're going to be losing 35, 40, 50% before it stops out. Risk capital is the initial debit, so that's a good part. It's fully defined up front. But in general, it takes a lot of experience and focused effort to make consistent long-term gains with directional trading. It is not easy. And now, the market, ever since January 1st, changed. What you notice is when the Fed finally stopped, they turned off their printing presses, QE is done, quantitative easing is done, the market really changed a lot, and it really whipsawed in January and February. Now it's grinding higher, and we're breaking out, but we'll look at all the charts also. But in general, I think 2015 is going to be pretty tough to navigate for directional trades. And I can see it because I'm doing directional trades in one of my accounts, and we're putting many hours a day into it, building track record, and it's not easy right now. And as I was saying, the current stock market it's expensive. We're at 17.2 times forward earnings for the S&P 500 companies, so directionals will be more difficult to navigate in 2015. Directionals versus non-directionals. Non-directional trades, such as index credit spreads and iron condors, they take a few hours a week when leveraging the MCTO weekly analysis. 7 months per year is really easy money, historically. Now, last year was not easy for us. We really struggled last year with the Fed involved and printing money and flooding liquidity into the market. The market was very difficult to trade and to time. So a lot of the non-directional folks really struggled, but I'll tell you, ever since January 1st, it just totally changed. And so I really like the market now. In general, for non-directional trades, the trades are open for 20 to 30 days. So we only need to be right for 30 days at a time. And that's what we care about through all of our robust analysis. We're trying to figure out, is the coast clear for 4, 5, 6 weeks? That's what we care about. Even 3 weeks, 4 weeks, 5 weeks. Is the coast clear? Trying to look at a lot of data giving us the highest probabilities of being able to do what we like to do for 30 days or 20 days, and then we're out, and then we worry about the next 30 days the next month. Also, we achieve results monthly, which is kind of nice. On the directional trades, whether it's options or just buying the underlying, sometimes a stock or an option will sit in your account for 3 months, 5 months, 7 months. At least with credit spreads and iron condors, you get results every 30 days. And we usually achieve kind of in the range of 15 to 30% annually, historically. It's best to diversify across several strategies with different weightings in general. I can't really tell you how to allocate your capital, but I can tell you what I'm doing. And right now I'm doing 25% in directionals, and I'm avoiding just the breakouts, you know, the ones that are taking out 52-week highs or 180-day highs, because I don't trust this breakout yet, and I'll show you all the charts. The market's expensive. We're at 17.2 times forward earnings. So that's it's not cheap. Market's not cheap. And could it go higher? Yes, it could. But I'll tell you, we're going to have some nasty pullbacks when we have them then, as this market gets more and more expensive. But I'm mostly focusing on recovering sectors, materials, energy. Now financials are starting to run a little bit. Also stocks that have pulled back. Those are the ones to, you know, pull back to the 50-day line or the 200-day line. Those are the ones I tend to gravitate toward, and not the ones that are breaking out. 35% of my portfolio is non-directional. This market, ever since January 1st, has changed compared to 2012, 13, 14, where the market was just driven by quantitative easing and the Fed, and it just had an upward bias. It just went straight up. 10% broad market indexes, ETFs, SPY, which is the SPX, that's the S&P 500. This is an ETF for the Russell 2000, and this is an ETF for the NASDAQ 100. In general, for the last 4 years, all you needed to do is buy some of these. That's it. Let it ride, and you made lots of money. Now, I don't like what I see with the market, or at least I'm being a lot more cautious because we are expensive now. And so I've cut way back on any broad market ETF for, you know, index exposure in my own portfolio. 30% also I'm pushing to Europe and Asia, and a lot of institutional money has been doing that for the last several months. Again, our markets are expensive, so most people are going where the quantitative easing is, where the Federal Reserve is active, and where the economies are at least where the markets are not as expensive. Okay, back to 90% probability index credit spreads and iron condors. So 90% probability that they will expire profitable. Also 10% that they won't. Now that's where adjustments come in. We're not going to talk about adjustments today, but that's the big part of these, because periodically a few will get into trouble. They'll get under pressure and we have to adjust them. These are also known as wide mouth iron condors. Historically, they tend to produce reliable monthly returns, and then we'll have, usually out of 12 months, we'll have 3 months where we'll have negative returns, but we can usually keep those under control historically. -5%, -7%, -3%. That's through having a lot of experience and knowing how to adjust these. Indexes are naturally diversified with hundreds or thousands of companies that compose the index. So that's since they're diversified, we don't have to worry about company and industry-specific risk. For example, CEOs accused of cooking the books. CFO steps down unexpectedly. Closest competitor announces a big loss. These are industry or company-specific risks, and a stock can move a lot when this happens. So I've learned a long time ago to focus purely on the indexes and not on stocks when doing credit spreads and iron condors. Writing credit spreads is like being the house in the casino. So we're on the other side of the trade. So we make money on both bullish and bearish bets. Okay, steps to make consistent monthly returns in credit spreads. Learn the mechanics of building the trade. Monitor big picture indicators. Since we're trading the indexes, we don't really need fundamental analysis on stocks. We need more fundamental but macro sentiment analysis on the broad markets. That's what we care about. focus on just a few underlying vehicles. As we said, we focus on the SPX, the NDX, and the RUT. That's the big caps, big cap tech, and small caps. Know how to adjust the trades if they get hit. Okay, we're going to focus on just 5 minutes here, learning how to build a trade, and then we're going to focus mostly on monitor the big picture indicators. That's all we're going to cover on this particular presentation. Okay, so this is an iron condor. This is a modern representation, a modern view of a risk-reward graph. This package is the Optionetics Platinum package. I got started with options with Optionetics training back in '99, 2000. Did a lot of training, a lot of coaching. I continued to use their tools, so I like their tools still. So on the left side is the underlying. Here, this is the RUT, and this is an old chart. This is 2007, and here's the values of the RUT, and it's a function of time. Here's time down here. And this is where the RUT closed for that particular snapshot that day. It closed at 8:30. Okay, here's actually the values of the RUT where it closed. 825, close 829.93. It was up $6.13 that day. On the right side is the risk-reward graph of the option trade that we're opening. This is a four-legged trade, and here we show the four legs up here. And we have sold a call here. This is the 890 call, sold July 07 and 890 call. We brought in $2.10 for that call. And then we bought a call one click higher. We bought the 900 call for $1.50. So what we sold it for and what we bought it for, we brought in more selling it, brought in 210, bought this call for $1.50, so you can see it's a credit. We brought in a credit for that bear call spread. So the top is a bear call spread, and the bottom is a bull put spread. So we sell a put down here. We sell the 760 put, July, same dates, July 07. Brought in $4.90 for that put. And then we bought a put for protection, bought the 750 put, bought July 07 750 put for $4. So there's a credit of 90 cents there. So we brought in about 90 cents on the bottom. And we brought in 60 cents on the top. That's about right. Okay, so you can make a good 15% on this trade if all goes well. Now, as a function of time, when I first opened this up, we had 55 days until expiration. And we see right here today, 55 days left. That's the red line, and that is how you figure out where you are with regards to profit and loss. Everything to the right of this horizontal line is profit. Everything left of this vertical line is a loss. Right now, at 55 days out, based on where the RUT is, the underlying, you come right across. Here's where it touches the red line, come down. This trade is down $100. It will fluctuate constantly as the RUT is moving. The goal is to keep the RUT between here, your short call, and here, your short put. So as time progresses, and as the value of these options decay, you'll see that this line starts moving over to the right. So 55 days out, we're on the red line. 31 days left, we're on the blue lines. It's moving over, so it's going over to the right, so we're making more and more money, or at least now we're at a break even. At 14, or whatever that number is, 19 days left, we're in green. Now we're actually in profit as long as the RUT is right in this range. It has to be right below that and above that, you're in profit. And at 0 days, you're going to be on this line, the solid black straight line, and that is expiration. And what it tells you is that if the RUT is between the short call and the short put, you just collected $150. That's your premium. Okay? So the risk reward on this trade is there's a 90% probability that this RUT will end up between here, and you're going to keep your $150. Now there's a 10% probability it's going to end up somewhere out here, and then the risk is about $850. Now, don't let that scare you, because anyone that has experience in doing these, you make adjustments. You don't let it run where you lose, you take a full loss. The full loss is an $850 loss. Historically, we've been at this for 10 years, done this for about 140 consecutive months. We can usually keep those losses at -3, -5, -7% for the month. So we roll these trades, we adjust these trades, we'll flip these trades, we'll do certain things to keep the losses under control. Okay, so this is a 4-legged order. These are all July 07s, 4 strikes, 2 puts, 2 calls. Here are the calls on the top: sold a call, bought a call, sold a put, bought a put, brought in a premium of about $1.50. That represents the $150 here, and that's what I can keep. Okay, if you want to learn more about this risk-reward graph, go to this website right here. So go ahead and screenshot that, or if you miss it, send us an email to support@monthlycasteroptions.com and we can send it to you. And you'll see this picture where I kind of point and define all the components of this risk graph along with some of the data. And this one, this shows the full iron condor. Okay. All right, steps to make monthly returns with credit spreads. Mechanics of building the trade, we just showed that briefly. The next webinar will be fundamentals of iron condors and credit spreads, and we'll spend a lot more time on building the trades, showing how we construct the trades through each of the legs, and then how to adjust trades and trading rules. Step 1, mechanics of building the trade. Step 2, monitor big picture indicators. All right, all the technicals of the charts, macroeconomic data, sentiment data, volume analysis, breadth, all these things. We'll cover all this right now. And then step 3, focus on a few underlying vehicles. Step 4, know how to adjust. So we're not going to cover that. We already basically said that we use just 3 indexes, but we're going to focus on this right now. What I really care about with this presentation is, where is this market going? It just broke out. It's expensive. Fed's going to start raising interest rates. So let's just start looking at all the charts and all the data that we look at. All right, so for the Dow Jones, you can see that it's basically has been in a wide trading range between 18,130, 17,200. Broke up once and failed, stayed in a trading range for another couple of months, broke up again. Now it's above 18,287, so we're at 18,300 now and change. The commodity channel index, once that thing touches 200, that's very overbought. So good chance this is going to kind of roll over and pull back a little bit, but this is just a short-term indicator. The MACD is looking a little bullish. Relative strength, I see some positive divergence. It looks good. If I were to draw a trend line, it looks okay. For the up day volumes, I see lower volume. It's not great. It should be higher volume, but many times you'll see uptrends on low volume. And the market will keep on going up. We got a 13-day EMA, 15-day EMA, that's exponential moving average, 100-day, 200-day. Done a pretty good job of climbing right up the 100-day line, and it's taking out higher lows. So if I were to look at that, I'd say, well, sooner or later, it's going to break up through. Might be a month, might be 2 months, might be 3 months, but it's starting to, it looks like it's bullish. What I don't like is this right here, the chicken money flow. This is a very powerful indicator, and it's basically, it uses advanced decline line data, the number of advancers minus the number of decliners, with some moving averages on it, and they look at the volume behind those up days and up bars and down bars. So it's very powerful, and this is telling me that there's not a lot of conviction with this uptrend right now when I see this type of chicken money flow. So I don't like that. Here's the SPX. Same chart. Looking, 20-day, I've got a 20-day line on this one, 50, 100, 200. Even better is taking out higher lows. I would say, regardless of what the economy is doing, this is going to break up through, and it finally did. So that looks good. How much higher can we go? Well, a typical next leg higher could be 3%, 4%, 5%. Could be. For every percent, it's about 20 points. So it could go up 100 points. It could. Problem is that Fed's ready to raise interest rates, and we're not cheap anymore. We're at 17.2 times forward earnings. So lower probability that this uptrend is going to be really steep. It could fail. It failed on some of the other indexes, and we'll see if this one fails. So for me, I don't want to chase this one. I do not want to chase this uptrend. For our directional strategies, I'm not chasing stocks that have broken out, because I need to see this go up, and it's going to roll over a little bit. I want to see where it tests. And if it pulls back and then bounces, and I see high volume starting to push this thing higher, then, well, that's confirmation that we're going higher, whether we agree with it or not. And we'll be up to 18 times earnings before you know it. Now, that's getting pretty expensive. I know some fund managers, that's the line in the sand. When we hit 18 times earnings, they're really, really getting cautious. They're starting to pare back their ownership of U.S. stocks, and they're going elsewhere. But, you know, let's just take this week by week, and we'll see where this goes. Here's the SPX, S&P 500 index, but it's the SPY. This is the ETF. I show this because we can show more indicators. And this all looks bullish. It looks okay. I see very low volume, literally 60% volume on that up day. That's not a lot of conviction. And then problem is, here's the chicken money flow again. That does not look good. So I want to see how this behaves. Here's the NASDAQ composite. This has about 2,700 stocks in it, so it's a broad representation of the market. Even worse, chicken money flow. Very low. And look at this one. We actually have negative divergence on this one. So I can draw a line from here down to here, where this thing, you know, this index has been breaking out and going higher, and my MACD looks pretty weak. I've also taken out a lower high right here. I can still draw a line that's going downward, not upward. So, you know, I can't come to any conclusions yet other than I have to be careful. We have to be careful. It failed here once. Up, 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 fail. But it found support at the 50. Broke up through again. Kind of failed again. But, you know, it's kind of choppy, but that's just how a breakout is also. I mean, you have weak hands selling stocks, and you have strong hands coming in and buying stocks. And sooner or later, all the weak hands are gone. So now you have strong hands who have conviction and who believe the market's going higher. Here's the Russell 2000. This one sold off a while back. The mid caps and the small caps. A lot of people were, you know, investors who made some good money on the small caps were ringing the cash register. Came down to the 100-day line, found support at 1220. That's pretty nice. That's a nice support level. Back up close to 1260. So most likely, all of this is going higher, and we're going to probably retest all these highs for the rut. Now, are we going to break up through in the rut? I don't know yet. I also look at volume analysis, and I don't cover that in this presentation, but it gives me some insight into the strength of the buying on the up bars versus the down bars. And so far, I don't see a lot of conviction in any of this buying yet. Here's the VIX implied volatility. This is volatility for the S&P 500 index, and we can see it's way down here, 6-month low. In general, when you come down to near 12.5 or lower on the VIX, recently and in general for the last couple of years, it's always a good idea to buy protection, buy some slightly out of the money SPY December puts, for example. Give yourself plenty of time to be right. Just buy straight puts. They range right now, I think a slightly out of the money SPY put is $5.50. And that's what I buy in our directional portfolio, where we'll have up to 10% of the portfolio hedged with SPY puts whenever VIX comes way down, because the SPY puts get cheap when VIX comes down. Volatility, this is a weekly chart. Just kind of gives you perspective of the disaster we had in 2008. And lower highs, 2010, 2011, and then the economy was kind of correcting itself. But we're digging out of a deep hole. We've never seen this before, ever. I don't think we've ever had a volatility, anything like that, in, you know, ever since volatility, implied volatility was even followed. Okay, there's one technical indicator that we can watch, and it tells us, are we in a long-term confirmed uptrend? And this is kind of a, you know, it's just a piece of concrete data that can help you make decisions. Do you want to stay in, or do you want to start getting out? This is the 1743 weekly EMA, exponential moving average, on the NASDAQ composite. Whenever the 17 is above the 43, and this is a very slow moving chart because this goes way back to 98. So exponential, moving average, 17, 43, 75. When the 17 is above the 43, we are in a long-term confirmed uptrend, meaning that if we have pullbacks, there's a high probability the 200-day line is going to hold. Also meaning that we're still growing earnings, meaning also that the economy is still expanding. Could be barely, but the economy is still expanding. When the 17 crosses down through the 43, what that tells you is that the probabilities have dramatically increased that we are going to start having negative earnings growth, possibly going into a recession. Could be a quick, shallow recession, could be just one quarter, no big deal, or it could be really deep. We don't know. It's hard to predict that. So just watch this type of chart. We show this every week in our analysis, every week in our advisory, and it moves very slowly. I update it once a month. And you can see that, and this vertical line basically was when the 17 crossed down through the 43. That was towards the end of 2000. Looks like maybe September, October of 2000. Basically said, get out and start looking for any excuse and any reason to start closing out your long positions. And usually that means whenever the stock carves down to the 50-day line. Stock pulls back, touches its 50, carves under the 50, get out. That's when the 17 is below. When the 17 is above, that means we're still in a long-term confirmed uptrend, and you can let things draw down because you're still, the economy is still expanding, earnings are still expanding, stocks are still money flowing into stocks. So back in 2003, that's when it triggered to get in, and then it kept you in the whole time. I think it mostly kept you in all the way through to January of 2008. It got you out. Now, traders love this. I mean, this is when, for our directional strategy, we're going to be going 70% bearish, 30% bullish. So 17 crosses, but now you don't get immediate confirmation until you see something like this. Usually the market will come down, and then it climbs, it retests one of these heavy-duty major support levels or resistance levels, it fails, and that's it. That's your confirmation that we are in a bear market. Make sure you close out all your long positions, and then if you're a trader, be buying puts or just go to cash and start buying bonds. And usually you want to buy the bonds kind of right here, right when this happens. Got you back in mid-2009. It was actually, yeah, it was like June of 2009. It got you in, kept you in, probably popped you out here because it actually was a pretty nasty sell-off, but it got you back in and it kept you in until now. So we're still in. So just remember this. This is very important. This is a major, gold nugget to remember. 1743 EMA. This is I've back tested this way back and have used it for a lot, and it's nice. It's a very nice indicator. It's just a technical indicator. You have to use it along with everything else. All right, kind of zooming in on this 1743. Mid 2009 got you in. You might have gotten thrown out here temporarily, but you're back in, and now you're in for 1, 2, 3, 4 years. It means high probability that the 200-day line is going to hold, high probability that earnings will continue to expand, and the economy will continue to expand. Okay, let's look at the industry sectors. So usually we have the spiders, the XLF, XLY, XLI, XLU. These are, financials, utilities, consumer discretionaries, consumables. So I'm going to look at a few of them. So these are just the broad sectors, and you want to watch these. I watch these in the advisory. So our advisory has 80 charts in it. I look at all this. So I basically just pulled all the charts out of the advisory. That's what I'm basically showing. XLF, actually there is cash moving into financials because the interest rate has popped up recently on the 10-year note. We're up to 2.15%, or maybe, no, 2.2, something like that, and meaning that banks could make more money. So immediately money starts flowing into the banks. These charts look okay. Shaking money flow looks okay. A little overbought, but bullish. And it's telling you that regional banks and money centers and just about all the financials, you're going to see some cash flowing into these, and they have been. Consumer discretionary, these are like cyclicals, consumer cyclicals, and these got really overbought. I mean, they've been really on a tear for the last couple of years. And I don't know if this is going to break up through or not. It looks like it might not. I see relative strength as compared to the SPX is dropping off. This looks as negative divergence of the MACD. This is pretty choppy, negative divergence, and then chicken money flow looks bad. So in general, like for our directional strategy, we're avoiding consumer discretionaries. When I see stuff like this is a sector we'll avoid. We're overweight in the financials, overweight on anything that I see money's flowing into, and avoid what's money's flowing out of. But I don't see a disaster. There's not a disaster here. It's just it has to take a long breather. There's money has flowed into this sector for a long time. All right, XLI looks okay. This one really got hit over the last 3 months, 4 months with the strong dollar, because most of these big companies, the XLIs, the industrials, are multinationals. They sell overseas. Dollar's strong. Their products are more expensive now, less competitive. You can see that ever since the strong dollar started getting stronger and stronger, the relative strength has been dropping off. Recently it popped up, got very overbought. Commodity channels at 200, so we're going to probably have a pullback a little bit. Chicken money flow is not great, but it's not as bad as what I've seen on other charts. So am I dying to like move a lot of cash into multinational industrials? Not really. Not yet. I think it's probably going to be dead money for a little bit. Maybe for a while, maybe for all of 2015, because we're raising interest rates. And some of these are interest rate sensitive too, especially the utilities, for example. Any companies that borrow a lot of money, they're under pressure. All right, this one's not looking good at all. Transports, and this one should be looking great. Transports, rails, truck, freight, air. The Dow theory says, transports plus the Dow needs to be, doing well. And this is not participating. So if you look at Union Pacific, any of the large rails, they've been rolling over for a while. Now some of it has to do with oil, because there's a lot of uncertainty in moving oil, and you constantly see trains derailing and stuff like that. And but regardless, the transports are not participating. This looks bad, relative strength comparison. This looks bad. This looks weak. This looks weak. This looks horrible. So one reason why I don't like this breakout yet is because the transports are not participating, and they need to. Technology, equal weight. So this is the MTK, equal weight, gets Apple out of there, makes everything equal weighted so you can really get a better picture of the technology stocks. Looks okay. I don't like the chicken money flow whatsoever. Technology needs to lead in order to really keep this market churning higher. Again, markets at 17.2 times forward earnings were expensive. It's just going to be blasting higher and really moving higher. Don't know. I think you have to be really careful on stock picking now and sectors within technology. There's always going to be some sector that's outperforming, and I think it's just trading now. You get into the sector, and 2, 3, 4, 5, 6 weeks later, you got to get out, book your profit. So we do a lot of that, a lot of sector rotation analysis, and I think the traders and active money managers are going to do better now with this type of market. You just can't buy like the Qs, which is the NASDAQ 100, and just let us ride. Okay, let's talk about breadth, market breadth. So here is a breadth indicator. This is called the SPX A50R. Comes out of stock charts. You can get this information for free. This is the percent of stocks above the 50-day moving average within the S&P 500. So again, the percent of stocks above the 50-day moving average of the 500 stocks that are in this index. So of the 500 stocks within the S&P 500, 65% are now above the 50-day line. So it popped up high pretty quickly. I got a couple indicators here, look bullish. I wouldn't say it's hugely bullish. I would say it's definitely an improvement. Is more cash going to be moving into the S&P 500 stocks? Yes, probably for the next week or two when we see this. Yes. So this is a breadth indicator that's very important to watch. This one is the NASDAQ composite, has 2,700 stocks. Again, the percent of stocks above the 50-day moving average. It's popped up quite a bit. It's gone from 40% up to 54%. Looks okay. This could easily roll over, and if it does, it's taken out a lower high. So high, low, lower high, lower, lower high, lower high, okay? Coming up, this could be another lower high. I don't know yet. We have to watch this for the next 2, 3, 4, 5 days to see if this recovers and gets back up into the 60s, high 60s, mid 60s. Advanced decline issues. This is a leading indicator. Very few true leading indicators out there, and this is telling you the number in the NASDAQ composite, the number of advancing stocks of that particular day minus the number of declining stocks of that particular day. So you take the advancers minus the decliners and you get a number. And then this one's cumulative, so it just keeps on adding yesterday's advanced decline number to the next day, to the next day, to the next day, et cetera, et cetera. And it looks like it's recovering, it's trying to, but it might be taking out a lower high. And if it does, this is not a good sign for this market, and there's a reasonable probability that this breakout will fail. But I don't know yet. We do not know yet, but all I know is for next week, we're probably going higher for the stocks because we have more advancers than decliners. McClellan oscillator on the NASDAQ composite. This one also uses advanced decline line, plus it uses some volume in there. And usually when it's over the zero, high probability that the stock, this particular index, in this case the NASDAQ composite's going higher. Kind of choppy, but right now we're probably going higher for another week. Okay, so those were just a handful of breadth indicators. You can get those in stockcharts.com. We show them every week in. This is just a selection. We have 50 of these that we look at each week, but I selected the 8 that I really look at a lot. But I got a few that there's probably another 5 or 6 go-tos that I go to, and they're all based on advanced decline line. Okay, steps to make consistent monthly returns with credit spreads. Mechanics of building the trade. We just briefly talked about the Iron Condor. Monitor the big picture. That's what we're talking about, and that's what we're going to finish off with. So we looked at the technicals of the charts. We're looking at price-based indicators on those charts, support, resistance, moving averages. Market. We looked at breadth. Let's actually talk about the macroeconomic data now. Macro data. We watch it every week. And the reason is we need to protect ourselves more. We were just purely technical traders pre-2008, and technical traders do great for a while, and as things are doing well, as long as the economy is expanding, as long as earnings are expanding. But if you don't pay attention to the macros, everything can be deteriorating around you, and you wouldn't know it. And that kind of happened to us, and it happened to a lot of traders back in 2008. So you keep on moving along with your standard strategy, and then all of a sudden everything blows up, and you're like, well, what happened? Well, if you look back at the data, everything was deteriorating since late 2007, and even some of the indicators in the housing market were rolling over in late 2006. Now, that's all hindsight 2020, but it's much better at least be watching the data, and we're watching for trends in deterioration if things are deteriorating. So, with regards to consumer credit, everything is fine. Consumer credit, like credit card, credit limits are just fine for the last literally 3 straight years. We've been adding $15 billion on average a month in extra credit going into the consumers' pockets that they can spend on credit cards. Non-farm payrolls look okay. They look fine. It's actually accelerating. Line up 100 people, there's going to be a lot of debate about the payroll changes and the unemployment rate and the accuracy of the numbers and all that, but based on just assuming that the data we get from the government is accurate, payrolls are doing fine. They're doing fine, and we're adding jobs. And with regards to losing jobs, here's the initial unemployment claims here and here. This is the number of people being fired from their jobs, and we can see it's been dropping, and it recently hit a 15-year low just last week. So initial unemployment claims, and here's the 4-week moving average. This is down to a 15-year low. So definitely companies are laying off fewer and fewer people. They're holding on to who they have, and we're seeing a lot more people now quitting their jobs in the last year and a half, so they're feeling more comfortable that they can quit their job and go find a better job somewhere else. So jobs look okay. Retail sales, a little choppy. Problem is that we had a lot of savings at the gas pump, but it was not translating into sales at the malls. People were still just holding on to what they're saving. holding on to that money to pay off debt. So if you look at the retailers, XRT is one of those ETFs that show all the retail companies, and it's been rolling over. I mean, retail sales has been a little weak. Industrial production is a mess. I don't like this one. This is really the total output of the United States. Utilities, manufacturing, and mining. And we've had 5 consecutive months of negative growth. So that's not good. I'm surprised I haven't seen too many articles written on this, but this is something that we just have to watch. I think the Fed is probably getting pretty concerned where, they want to raise interest rates, but if they keep on seeing total industrial production output from the United States shrinking, I don't know. My guess is most likely they will be raising rates just by 0.25, just to kind of get going on it. But that's not going to raising by 0.25 or 25 basis points will not really do anything to the economy, and they'll probably do it in September or December. And then they'll just be they're just going to take their time. But at least they can get going on the normalization path on interest rates. Capacity utilization, this is the first time I've ever seen this thing blip like this. That's not good. So a little too early to come to any conclusions, but this is not good, this is not good. Housing is okay. This is Case-Shiller housing. This represents, it goes back to 1987 up to 2015. This is kind of their index representing the overall prices of housing, and then they collapsed, and then now they're coming back. And they've been coming back for a long time. So housing is under control. It's expanding. Housing stocks look okay. We have these diffusion indexes. These are the ISMs. This is the Empire State. New York just has to stay above 0. It is, but it's a little weak. And here's the ISM for across the United States. It has to stay above 50. And if it's above 50, it says that our economy is still expanding. Manufacturing is still expanding. So it is. It's okay. But it has been dropping. Just remember, this is a very highly overrated economic indicator. They literally have, I don't know, a couple hundred employees, and they call maybe, I don't even know the number, 2,000, 3,000, 4,000 manufacturing plants, companies, and they ask the purchasing manager, are things better or worse or the same compared to last month? That's called a diffusion index, a diffusion survey, and it's really not that accurate. So, but a lot of people follow it, so we have to follow it. But it has been dropping off. Seasonal trends. I just kind of threw this in under macroeconomic indicators, but this is really in its own ballpark. But average monthly percent change for the Dow Jones over the last 100 years, 50 years, 20 years. It's usually flat. Now, it actually shows a positive number here, but if you look at it for a couple other different indexes, it's just totally flat. Usually May is really kind of a sell in May, go away. A lot of people will do that. Traditionally, when the market's normal, things will be okay through the first couple of weeks of May, and then all of a sudden people just start leaving and selling their stuff, selling their holdings, and going on summer vacation. So usually May is pretty flat, or sometimes we have a swoon in May. But it's just one data point, and it's not accurate all the time. It's just a seasonal data point. Construction spending looks okay, but it is getting choppy, and it seems like it's taking out bigger lows. This is 9% of GDP. That's a big component of GDP, so we need construction spending to remain strong. The trend doesn't look great, but that's where it is right now. GDP right here, overall gross domestic product for the United States, we're about 2%. It might be the new normal, for a long time. If we're growing at 2%, we'll have to live with it, but at least we're expanding. Okay, so that's on the macro side. Overall, muddling along, 2% GDP growth. We've been missing, a lot of this data has been missing. A lot of the data has been looking kind of bad, but we also went through January, February, unseasonably cold weather. That didn't help, and so we're seeing some of that data show up in the economic data. All right, corporate earnings. That's what ultimately drives the stock market. This represents the S&P 500 companies, aggregate earnings, forward 12-month EPS, earnings per share. So that's the blue line. take all 500 S&P 500 companies, add up all their earnings together, and you end up with about $124 worth of earnings. That is our predicted forward-looking 4 quarters worth of earnings, 124 bucks. So now if you want to get the PE, you would take what the SPX is currently trading at, and that's the left over here at 2100, 2130 divided by 124 bucks, and you end up with the PE ratio of 17.2 times. Okay, so again, market's not cheap anymore. 17.2 times forward earnings. This is where the number came from. FactSet is where I get the data. And a lot of this rollover was from energy companies. They cut their earnings estimates by 30, 40, 50%. So we'll see if it bounces back. But right now we're at about 124 bucks worth of forward earnings. Big picture, things have been good. See, earnings are growing ever since 2009, April. Earnings have been growing. We generated, these 500 companies generated 62 bucks worth of earnings back in 2009. And they've kept on raising earnings, all the way up to 124 bucks. So that's good, and earnings growth will drive stock prices. Treasuries, 10-year note. It popped up all of a sudden. This is the interest rate here. We're up to 2.14%. Overall, it's a good thing. I mean, we want interest rates to be a little higher. I mean, it's good to have low interest rates, but the economy's been very mangled, and we've had very low interest rates. It's hard to explain also why they're so low. If the economy is expanding, why are interest rates down at 2.1%? But if they pop up, it just tells us that people believe that the economy is going to start expanding. And here's all the bond holders. They've been buying bonds up to here. Now they're starting to sell their bonds. This is TLT, which is the underlying, it holds a bunch of bonds, basically futures of bonds, or just the bonds themselves. And people have been getting out of bonds. All right. So overall, it's a good thing, and we can hopefully, interest rates will be up to 3% before we know it. And I mean, that's okay. The economy will probably not stall out. It will stall out when the Fed really pushes up interest rates, for 10, 15 consecutive times, and then they'll start stalling things out. High yield bonds. All right, what I care about for high yield bonds is the coast clear. Coast clear means high yield bonds. This is like corporate debt. Companies are issuing debt. Energy companies are issuing debt, $1 billion worth of debt, for example, to go drill a bunch of holes to see if they can get oil. And as long as this stays stable, it tells us that there's not a lot of stress in the high debt markets, and everything will be okay for another 2, 3, 4, 5 weeks. When high yield bonds start selling off, this will flow and bleed into the stock market, and stocks will sell off because this represents risk. This represents risk off. So high yield bonds, at least the underlying bonds, people have been getting back into these funds. It looks okay. It's somewhat stable. At least right now it is. We watch this from literally daily to week to week to week to make sure it stays stable. The spread between high yield bonds and treasuries. So the difference between the two, that's important to follow. You can see that this was one of the earliest indicators. Look at this. In 2007, 2008, actually 2008 is way over here. So even in late 2007, the spread started climbing. The bond market is some of the earliest indicators you're going to get when it comes to financial stress. Right now, all of this was from the crash in oil prices, because all the high yield debt that these oil companies and energy companies issued was stressed out. People were worried that that debt would default. So you can see that the yield of the high yield debt went up, and the spread went up between high yield and treasuries, like the 10-year. It's been dropping recently. So the stress has dropped. Things seem to be somewhat under control. It means the coast is clear for 6 weeks. The US dollar versus a basket of currencies. The dollar took off in July of last year, appreciated a lot, took out a double top. You can see that's a little lower there, increasing the probability we're going lower, and it did, along with negative divergence on the MACD. And the dollar's probably going to get stuck between 24 and 26 for a while. But I don't know. I'm not a currency expert. All I know is that this impacted the big caps, the S&P 500. We knew there was a headwind against the S&P 500, so that's why I was overweighting on the calls for the S&P 500 companies, because the dollar was climbing. So fewer and fewer investors wanted to buy S&P 500 stocks. But now they want to buy S&P 500 stocks because the dollar's been dropping. All right, big picture sector performance. We're looking at the S&P 500 versus the Dow Jones, NASDAQ 100. This is big cap tech, equal weight tech, mid caps, small caps. I'm looking at 30 days, and this is relative performance. So Wilshire 5000 represents the broad market. And in this particular tool, this actually comes out of stock charts. When I click on the Wilshire, it normalizes the Wilshire 5000 right to 0. So now everything else is relative performance to the broad market, to the Wilshire 5000. So for example, in around May 1st, we can see that the pink, or the NASDAQ 100, outperformed the broad market by 2%. And that we can see, for example, around May 11th, that the S&P 400, that's the mid caps underperformed the broad market by minus 1.4%. All right, so what I care about this, especially for credit spreads and iron condors, is I want to know where the cash is flowing. So if I see, RUT just taken off, here's the Russell, it's way down here now, it's underperforming. But if that thing were just going straight up, I have to be really careful on those calls, because I can see where the cash is flowing. So for right now, the RUT is still underperforming. Small caps are underperforming. Mid caps are underperforming. I care about NASDAQ 100, the big cap techs, broad tech. So there's some breadth involved, which is good. It's not just big caps, but it's breadth. There's a lot of technology companies are participating, which is good. So they're all outperforming, and then the big caps are outperforming. So everything looks okay. I mean, it looks healthy for another week or two. We have to monitor this constantly. All right, let's look at the sector rotation between industry sectors. Cyclicals. These are consumer cyclicals. This is XLY, XLK, industrials, XLI, materials, XLB, energy, XLE, consumer staples, healthcare, utilities, financials. These are all the spider broad sectors. Same thing, I'm looking at 33 days up against the Wilshire 5000. I null out the 5000 down to just broad market. So now everything else is relative performance to the broad market. We can see energy was outperforming by over 5% in April, late April, and now it's outperforming by 1%. By the way, in my opinion, I think that's a buying opportunity. So we are picking up energy stocks when they pull back to their 50-day line. Some are pulled back to their 200-day line. So I think that's a buying opportunity, as long as you give yourself plenty of time to be right for those energy stocks. Utilities, they've been underperforming. They're interest rate sensitive. Interest rates have been going up recently, so they're just kind of choppy but underperforming. Financials are outperforming now. They're going to be outperforming even more over the next 30 to 60 days, most likely, as long as interest rates stay around that 2.1% and higher. So what I care about really here is I want to make sure technology is up here outperforming. It is. I want to see, okay, materials are outperforming. That's good. We haven't seen that in a long time. I want to make sure that utilities are probably underperforming, and that's good. They are. I want to make sure financials are outperforming. They are. That's good. Healthcare, it could be anywhere. Industrials would be nice if they were outperforming. They are. So everything looks pretty good. So, it looks good. I don't see, any huge red flag. I don't see any impending crash. I do see at any time we could pull back 5% at any time. I mean, we're not cheap anymore. So could we have a fear-based pullback and sell-off? Yes. However, because we're still expanding, pretty good probability that the 100-day EMAs or the 200-day EMAs will hold during these pullbacks, and those are buying opportunities. And 1743 EMA, we showed you that. That was the weekly. That's still in a confirmed long-term uptrend. I just think these pullbacks, when we have them, they probably will start getting really nasty. They're going to be pretty violent when you're at 17, 18 times forward earnings. But we watch a lot of data trying to at least try to sidestep those or at least be ready where we can underweight on the puts and we'll overweight on the calls when we start seeing some red flags here and there.